It was reported today on Wednesday, August 21st, that the BLS, the Bureau of Labor Statistics, revised down the non-farm payroll growth numbers by 818,000. This is the most significant downward revision since 2009, and the BLS said that the actual job growth was nearly 30% less than what was initially reported. So what does this mean for the actual health of the economy, and could this affect Fed monetary policy decisions going forward? We'll be talking about Fed policy today as well. We'll be going over the July meeting minutes, which revealed that the Fed will likely cut by September. They use the word likely. So how significant would these cuts be? And more importantly, how would the markets respond? Stocks and bonds and commodities. We'll be going over all these topics with our next guest, Bob Elliott, co-founder of Unlimited. Bob has spent several decades working on Wall Street at some of the biggest hedge funds in the world, including Bridgewater. This episode is brought to you by iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you'd like to learn more and get started, click on the link down below or scan the QR code here and get $100 in signing bonuses if you fund your account using my referral link. Bob, welcome to the show. Good to see you.
Thanks so much for having me.
Before we talk about the economy, it's your first time on the show. Maybe just give us a 30-second bio, where you were before Unlimited, your career, what led you up to this point.
Yeah, my career has been more than a couple decades as a systematic macro investor. I was at Bridgewater Associates for a long time, almost 15 years, where I created investment strategies across all the major asset classes. And then after I left, I sort of flipped my worldview, and instead of creating proprietary 2 and 20 strategies and being a manager, I now run a company that has replicated those hedge fund strategies and makes them available to all investors at a low cost. So that is trying to challenge the entire hedge fund industry in terms of its costs and liquidity and tax inefficiency.
Well, I usually start with people's macro views, but let's flip it around today. Let's start with actually your asset allocation and how you would be, I guess, tactically and or strategically positioned right now.
Well, I think the big picture for most folks on a savings, thinking about their savings portfolio, is that they are almost always heavily overweight stocks and bonds relative to other assets like gold and commodities and tips. And I think this is a really great opportunity to rethink that. I think there's a couple different ways in which you want to rethink that. With stocks and bonds essentially close to highs here on a near-term basis, it's a good time to diversify into those other assets. So one, improving your inflation protection. Right now, what's happening in the market is inflation is priced across markets to fall to 2% or even lower over the course of the next couple of years. That may happen. But the risk for most savers is that inflation is higher than what's expected. And now's the time to protect yourself, whether it's gold or tips are two important ways that you can do that. And the other thing to think about is whether you're protected from broad scale geopolitical risks. The 60/40 portfolio is great in a period of peace and disinflation, and that may not persist in the future. And that's where things like gold and diversified commodities can be beneficial for a portfolio. So good opportunity to find diversification given, you can sell your stocks and nominal bonds at highs.
I just want to get clarity on what you said about bonds being at all-time highs. Which bonds are you looking at? Because I'm looking
near-term highs, nearterm highs, not all-time highs. No,
near-term highs.
Bonds,
okay.
With yields having fallen into the,
okay,
have fallen substantially.
You're looking at shorter-term bonds because the TLT, for example, is trading. It's 99. It was at 180 just 3 years ago, right? So, are you looking at?
But bond yields were at 5 not that long ago. And so the point is you have a near term circumstance where bonds have rallied a lot. And in particular, they've rallied a lot on expectations of an incredible pace of Fed cuts. Right. We're pricing in something like 200 basis points of Fed cuts in the course of a year. That's only happened basically during recessionary environments. And so if you're looking at that and you're looking at bonds, particularly long term bonds, that are pricing in inflation expectations over the next sort of 3 or 5 years that are below 2%, that's a time when you want to think about diversifying out of those assets because most of the outcomes are skewed worse for bonds ahead rather than positive for bonds ahead.
Fed cuts are expected, or rate cuts are expected by this September, which is the next meeting. Suppose the market's right, suppose the consensus is right. How's that going to impact yields, both the short end and the long end of the curve?
Well, right now, whenever you're trading bonds, a big part of what drives the returns is how interest rate cuts come in relative to expectations. So you got to, first thing to understand is what's priced in for expectations. That's where that 200 basis points of cuts in a year is priced in. It's already priced in. So in order to be a bond buyer, particularly a short-term bond buyer here, like on twos, you have to believe that the Fed is going to cut faster than 200 basis points and meaningfully faster for it to make sense to hold as a trade. And if you look back through time, typically central banks, they raise interest rates fast when inflation is surging up, and they cut interest rates fast only when growth is declining sharply. And we don't see any signs of that in the economy right now. So it's very unlikely that the Fed is going to deliver the magnitude of cuts currently priced into the short end of the curve.
So your view is that rates will rise from this point?
No, just simply that I should say the cuts will not be as significant as what's priced in, which will put a pressure for bond yields to rise.
Well, let's talk about, before we talk more about bonds, let's talk about Fed policy itself. So I'm looking at today's data, for example. So today's news, non-farm payroll growth revised down by 818,000, according to the Labor Department, a magnitude not seen since 2009 in terms of a downward revision. It says here the BLS said the actual job growth was nearly 30% less than the initially reported figure last month. So how is this going to impact Fed policy at all? Keeping in mind
it's not going to impact Fed policy at all. And the reason why that is because basically these revisions were known. We could go down the rabbit hole of talking about QCW revisions, but the gist is that that every year there is a revision. This data is for April of 2023 through March of 2024, so it's very stale and old. It's not reflected or influence. It doesn't influence the printed unemployment rate because that comes from a different survey. And the big picture is like during that period, employment was pretty good, getting, something like 175,000 jobs a year or a month for an economy that, whose natural rate of employment growth is probably, and labor force growth is probably closer to 100,000. So we went from a very strong job market to a, decent job market based upon those revisions. And those people who follow this closely, we already saw signs of this revision happening in previous quarters. And so this is a very incremental piece of information. And the markets took it that way as well, in the sense that markets didn't meaningfully move on the news.
Oh, well, forward looking then, can you give us some guidance in terms of how the labor market can progress or evolve from here? 4.3% was the latest unemployment reading. Is it going to take higher, Bob, do you think?
Well, I think we're in a process of gradually slowing economy as interest rates have been elevated for an extended period of time. But that slowing is very gradual. The unemployment rate shift is probably the weakest indicator of any indicator, whether in the labor market or the broader economy, and partially overstated by the fact that it was driven up by a substantial amount of new entrants as well as temporary job layoffs. And so we're unlikely to see an acceleration at the pace that we've seen in the last couple of months that were influenced by those sort of transitory or one-off factors. Much more likely what we'll see is a gradual meandering up of unemployment very slowly and a gradual slowing of GDP. But at a big picture level, this is not an economy that, if you have an economy that's growing in a real basis at 2 to 3%, and you have inflation that's still at 2 to 3%, and you have stocks at all-time highs and spreads at all-time lows, that's not a combination of dynamics that is consistent with 200 basis points of Fed cuts in the course of 12 months. It's totally inconsistent with that.
Okay, so you think the markets are too aggressive in pricing in how many cuts we're getting. So how many do you think we are going to get realistically going into next year?
Well, if you're trading markets, the question isn't necessarily you don't have to pick your cuts precisely. But what I'd say is I think it's going to be a pretty slow process. We're talking about a handful of cuts through the course of the next 12 months. Nothing like, I guess, the eight 25 basis point cuts that are priced in. And certainly, if you even just look at the September numbers, the market pricing today is still for something. It's about a 60-40 on 50 basis point cut. If you look at the Fed minutes that were released today, nothing indicates that there would be a move for 50 basis points. You would have to see an incredible weakening of the labor market in the one print that we have between now and September to get anything close to that. It seems highly improbable that you would get 50 basis points of cuts given what we're seeing comprehensively with the labor data.
So let's go over today's Fed meeting. The vast majority of participants at the July 31st meeting observed that if the data continued to come in at about expected, it would likely be appropriate to ease policy at that next meeting. So yeah, basically what you just said is well telegraphed. Are you expecting any market movement on a rate cut in September at all?
Well, I think the main question is going to be how they describe and indicate the pace of their movement, and also where they think the endpoint is. Right now, the short rate markets are pricing in a neutral rate that's something like 2.5%, which, to be clear, is basically what the neutral rate was pre-COVID for during the depths of the post global financial crisis deleveraging. And I think a big question is going to be is there going to be a reassessment of what that neutral rate is? If you just look empirically, what's neutral, very hard to understand theoretically. If you just look empirically, like real GDP growth or final sales have been basically flat between 2 to 3% over the course of the last 8 quarters. With interest rates at this level, it's not clear to me that the neutral rate is meaningfully lower than the current rates that we have today.
Historically, how have markets behaved following a Fed pivot?
Terribly. Like, the short story is the Fed cuts at a time you certainly don't want to be holding stocks, right? Like that's the basic picture. And the reason why that is that the Fed and all central banks, not just the Fed, they become active in terms of easing monetary policy when growth conditions are deteriorating rapidly. Fed cuts are bad for growth, are typically aligned with bad growth conditions.
Well, okay, the basic finance 101 theory, you bring down interest rates, your discount rate goes down, valuations go up. Why isn't that applicable here?
Yeah, the question is what's the motivation? If what's happening, and we saw a little bit of the market scare earlier this month, which is that if the expectations are the Fed's going to cut rapidly because the unemployment rate's rising aggressively, then that's a very bad picture for stocks. Now, I think that was an overreaction in a thin market in the middle of the summer. But what you see there is it highlights the linkages, which is like, look, if the Fed is going to cut quickly, for instance, the Fed will cut 200 basis points if the economy is falling apart. That's certainly possible. If the economy is falling apart, you certainly don't want to be long stocks. And I think that's where, if you look at what's going on, stocks at all-time highs, very high earnings growth expectations, very high PEs, stocks are pricing in essentially 100% probability or a 0% probability of recession, and bonds are basically pricing in 100% probability of recession. And that's basically, both of them are wrong, which means that both of them are likely overvalued relative to their prices today.
Well, what's the catalyst for this overvaluation to finally be realized from a correction perspective? In other words, the trigger for a correction.
Well, I think we're likely to see on the growth side, you're likely to see economic activity not be nearly as strong as what's necessary to deliver those sorts of earnings that companies are being priced in for. And on the other side, you're likely to see growth that's a little too strong for the Fed to deliver the cuts that are currently priced in. Now, that combination of things, that's not, there's not an acute crisis. And typically in late cycle environments, there is no acute crisis. It's a little bit like death by 1,000 cuts rather than an acute move. We've only sort of become accustomed to that in COVID and the 2008 financial crisis. And probably what we're going to see is sort of worst Goldilocks economic conditions over the course of the next 12 or 18 months, which satisfy neither the stock bulls nor the bond bulls.
Okay, I'm going to come back to acute moves in just a minute, but okay. So the inflation number comes out next month before the FOMC meeting. So the CPI release is on. Let me just check the date here. The August number comes out September 11th. The FOMC meeting is on the 17th, 18th. Will be the press conference. So what does the inflation? Let me phrase it this way. What does the inflation number have to be in order to incentivize the Fed to cut 50 basis points?
I mean, the Fed's not going to cut 50 basis points on it. And certainly they're not going to cut 50 basis points related to the inflation number.
Really?
The
So
reason
there,
why that,
let's hypothetically, let's say inflation, I don't know, it falls to 2% next month. That's not going to happen. But let's hypothetically, the Fed will still say, all right, 25 is enough.
like anything that's within the realm of plausibility, the
Okay.
inflation number is not going to be the thing that's going to cause them to shift their
Interesting.
policy. If you look back all through time, central banks do not meaningfully rapidly cut rates in response to falling inflation. It's not what they do, because there's no urgency. Lower inflation is not a problem. Lower inflation is a good thing in general. I mean, obviously, if you get the deflation, it's a problem, but lower inflation is generally a good thing. And that a softening inflation number wouldn't necessarily be particularly indicative of what's going on with growth conditions. The thing that would cause them to move to 50 basis points is if we saw a meaningful stepwise change in what's going on in the labor markets, where you saw maybe unemployment rate moving up, a few tenths in the next report.
Well, that begs the question as to whether or not they need to move rates at all. I mean, the inflation rate has been coming down naturally on its own with rates maintaining the way they are. So why bother changing things?
Well, I think that, that's a good question. As I said, if you just look at, if you were to take the path of what's happened out, and I were to just drop you into an economy, at some random time, and I said, growth is, 2 to 3%, inflation's 2 to 3%, stocks are at all-time highs, spreads are all-time lows, and interest rates have been basically where they are today, for the last 2 years. What would be the typical response? And I think the typical response would be to not do much, because the economy is generally growing fine, asset prices seem strong, inflation's still a little too hot, and therefore you probably shouldn't, aggressively cut. But I think what's happening is we're looking at the path getting to this point rather than looking at this point objectively and thinking, okay, well, then they've got to go normalize rates. There's no reason to normalize rates unless there is a growth impulse to normalize rates. Or to lower rates. And I think that sort of speaks to the general point, which is that if you've been through these market dynamics over time, over the decades, what you see is there's constantly this view we're going to go return to normal, when in reality, central banks move a lot slower in returning to normal and what is normal than people expect. And I think we're setting up for the same exact thing. Remember, there were 7 cuts priced in for 2024 starting, as of December a year ago, right? And that did not get delivered, not close to being delivered. And yet people are speaking with the same confidence that we're going to get 200 basis points of cuts over the next 12 months as they did back then, even though the short rate market was dead wrong back then, given the economic conditions.
The theme of last year, 2023, up until I would say November or even October, was everyone calling for, well, not everyone, but a lot of people calling for a recession. I think bears overwhelmed the bulls last year. That's more or less, at least on media that I've observed, that's more or less balanced out. Why fundamentally did the bears get it wrong last year? If you were to look, hindsight's 2020, but if you
Well,
were to look
just
back,
to
the
be clear,
major
the Bears
assumptions.
did not. Yeah, the Bears did not get it fundamentally wrong last year. That's an important thing to remember.
Okay, let's talk about that. Yeah.
What happened was there was the greatest easing of financial conditions supported by the Fed and Treasury on November 1st that arrested the declines in asset markets that were going on, right? So what you had was not the market left to its own dynamics would have continued to sell off. Both stocks and bonds would have continued to sell off. But what happened was you had a monetary and fiscal policy intervention in the markets to arrest those behaviors and create another leg up in the stock market and a leg up in the bond market. And so that was the dynamic, was, an unexpected, and to be honest, like not a particularly fundamentally driven easing effort by the Fed and the Treasury, which reversed the market action.
Yeah, let's talk about the Treasury. This is theory going around that, yes, the Federal Reserve has engaged in quantitative tightening, but the Treasury counteracted this by a few things. One, restocking of the Treasury general account following the debt ceiling debacle last year, but also the Treasury has just been issuing shorter term debt and thus pushing down yields of that. So that in itself was almost equivalent of QE, right? Is there any truth to that?
Well, I think anytime you think about bond markets, you want to think about who's doing supply and who's doing demand, right? Who's coming in and issuing and who is demanding those bonds. And so, on the margin, if the Treasury is issuing less duration, then that means that there's effective issuing bonds is effectively a bond sale. And so if they're issuing less duration, there's less pressure on bond yields. The reality is that a lot of that dynamic hasn't really been in play over, since basically November, where the Treasury made it clear that they were not going to return the bill share back to anything close to where it was, just after COVID. And so once that decision was made, largely that hasn't been a big story in terms of what's been driving the bond markets. The reality is what's been driving the bond markets, over the course of the last, certainly for this year, have been the macroeconomic fundamentals. So, shifts in expectations of growth and inflation.
Are you concerned about shifting gears now? Are you concerned about liquidity tightening up, bank failures, so on?
No, no. And just for perspective, I led Bridgewater's research on the global financial crisis and the banking system losses. Was one of the earliest people talking about trillions of dollars of losses. I know the banking system well. And I think there's been a big shift in terms of the regulatory framework, the capital available, the liquidity available, and policymakers' understanding of how to respond to these circumstances if they come up. And the banking system is not something to be worried about at this point. And I think it was pretty clear post SVB when many people said that was going to bring down the banking system and the economy. And I was strongly in opposition to that, thinking that the economy would roar on. And what we've seen 12 months, 18 months later is that the SVB and the problems that existed there were pretty tiny in the scope of the overall economy.
Well, do you think delinquencies on auto loans or houses or any other debt, consumer debt, would rise, therefore putting additional stress on banks to write off some of these debts?
Banks have huge amounts of capital, and even things like CRE, which is sort of the credit risk of choice. Just for context, CRE charge-offs are running at 25 basis points, and the NIM on those loans is 350 basis points. So to be clear, since that's become a problem, banks have made in interest income 10 times as much as they've charged off on those loans. And our shiny office buildings in urban cores like getting repriced or whatever? Yeah, of course they're getting repriced. But that is a teeny tiny portion of the overall CRE market, first of all, let alone overall bank balance sheets. And this is not a meaningful concern. And to the extent that it is, there are issues. Those charge-offs will take a decade to play out as they get restructured and pushed out and modified and things like that. This will not take down the banking system.
Okay, well, I want to talk about systemic risk and acute market moves, which you brought up earlier. So let's address the last semi-acute market move we had earlier in the month. It was less pronounced here in the U.S., but globally, like Korea, for example, August 5th, August 5th, and the Nikkei was down so much that they had to trigger the circuit breakers. But anyway, what caused that? There's been debate as to whether or not the yen carry trade unwind was the sole cause. What do you stand on this?
Well, I study how hedge funds are positioned for a living, and have built technology that lets me see what's going on. And a lot of the driver of what we saw was the second and third order consequences of hedge funds being caught off sides and other levered investors being caught off sides on certain positions, which created second and third order knock-on effects in the global asset markets. And so really what happened was this all started with a slightly softer CPI report, which created a rotation away from growth stocks into the Russell 2K stocks by
That was July,
um,
right? You're talking about July?
yeah, by
Yeah.
July, by market neutral hedge funds. That then created increased perceptions of risk, which caused broader hedge fund and levered books to start to delever, um, particularly where they were over positioned, which was really in places like the stock market. And so what was happening was those levered entities, those levered hedge funds what they were doing was trying to catch up on returns by going long high growth stocks. And when those underperformed, they had to cut those books. That created a drawdown in the stock market, which created concerns about the fact that the Fed would need to cut, concerns about growth, and the fact that the Fed would need to cut. You saw a sharp move in the 2-year interest rate and the bond curve in general. That created a very direct knock-on consequence on the yen. I won't go into all the details, but the linkage is bond market, the US bond market drives the yen and not the opposite way. And so therefore what happened was the yen rallied a ton in response to the US bond market action. And then as a function of that, the Nikkei then fell because most of those companies have, vast amounts of foreign earnings, which are when priced in yen, when the yen rallies, they underperform almost mechanistically as a function of that because their foreign earnings become less valuable. And so that's the knock-on effect, not the other way around. The yen carry trade, like in terms of orders of magnitude, just think about it this way. The amount of losses on yen carry positions were probably, I don't know, 10 billion during that period. And the total losses in the US, in the global equity markets were 6.5 trillion. Like the orders of people who saying that it was the yen carry trade driving the rest of the market action, like the orders of magnitude aren't even in the ballpark. It's a silly way. Typically indicative of someone who doesn't actually truly understand the inner market action of the way the global financial markets work when they say it's the yen carry trade instead of saying it germinated in the US and then had knock-on consequences elsewhere.
Okay, so bottom line, do you see or do you not see a credit event looming that could potentially move the markets in any significant way?
There's no credit event looming.
Hmm. Okay, fair enough.
You
Very simple.
want to answer that question? There you go.
All right.
Like if you're gonna see the risks are much more around expectations
Yeah,
being a problem than they are around credit risk being a problem. And we saw, COVID was a bit of an outlier,
sure.
but like those folks who lived through the US financial crisis, they see the world as where is the credit risk? Where is the credit risk? Like there's no credit risk, right? Leverage is down, capital is up, financial intermediaries are very sound, totally different from where we were in the financial crisis. The problem is that we're expecting to get double-digit earnings growth across the equity markets, and we're expected to get, incredibly aggressive Fed cuts, neither of which seem particularly plausible given the underlying macroeconomic dynamics.
Well, speaking of allocation, so you follow large institutional investors. Berkshire Hathaway made headlines all throughout the year by stockpiling cash or adding to their cash positions, which are now at historic levels of high. Why have they done that? Is that, are they just
Because assets are
reposition?
too expensive. I mean, everything's too expensive.
They're taking profits, but they're not, they're not expecting some sort of crash.
Well, I mean, they're taking profits, crash or no crash. Who knows exactly about that? But,
Sure.
I think basically what they are is they're traditional value investors over the long term, right? They're looking for value in companies and they're looking across the market and they're saying everything's too expensive. I mean, like, look, you've got, 12-month forward earnings, at least in the US context, are expected to grow in something like the mid double digits. That's pretty unusual for an economy whose nominal growth is 5% and whose late cycle, very unusual. Not to mention the fact that 12-month forward PEs are basically where we were, just off of where we were in the 2000 stock bubble. So, that's very rich on an economy-wide level.
Consumer spending. Are you expecting any changes to consumer spending patterns following a Fed pivot?
No, the consumers are not influenced by Fed behavior, very, very marginally, I guess, on the interest rate side. But the big picture, when you think about this cycle, which is pretty different from past cycles, like the reason why Fed hikes have not influenced, not slowed the economy rapidly as was expected, is because this is an income driven expansion and not a credit driven expansion. And that's a really important distinction because let's say, you're a household, your income's going up 5% a year, which is kind of the average household income growth. And your spending growth is going up 5% a year, and you own your home and you've locked in your mortgage rate and you've paid off your cars. Like, what's it matter if interest rates are 2%, 5%, or 10%? Like, it doesn't really influence what your incremental behavior is because you're just spending out of your income. And that means that the economy is on the upside was more resilient to rate rises than basically anyone expected. It also means on the downside that cuts probably aren't going to meaningfully influence your behavior. If you've locked in your mortgage at 3%, rates have to come down a lot from that 3% line in order to meaningfully influence your behavior.
At what point will consumer lending products start to decrease their rates as well? Credit cards, lines of credit, auto loans, all these things that could go down, incentivize people to spend more money.
Yeah, I mean, auto loans like on the margin, credit cards, the vast majority on a dollar weighted basis is revolving, so the rates really don't matter. It could have an effect on auto loans, but it's just, autos aren't a big driver. I mean, the real driver is what goes on in housing, and mortgage rates have come down, and we haven't really seen an increase in housing activity, in part because it's at current prices at basically any level of mortgage rates that isn't back to something like 2 or 3%. Houses are very expensive, and activity is highly depressed. So you're gonna have to get a huge move in rates to get a meaningful responsive effect from the consumer sector.
Okay, so bottom line, final question now, Bob. Bottom line, to sum up your economic views, historically, if you look at Fed pivots, whenever the Fed keeps Fed funds rate unchanged for a while, in other words, it plateaus and then it goes down. So a pivot, an Edinburgh designated recession typically follows. In fact, there's been very few exceptions where this was not the case. Is this time going to be any different?
No, because probably what's going to happen is the Fed's not going to cut anywhere near what's priced in because the economy is stronger than what would be needed to get all those cuts.
If they cut all the way back down to zero, hypothetically, would that stave off a recession?
Sure. I'm not sure the economy is on the path to be in a recession, even if rates are, basically where they are right now.
Okay.
That's so, I mean, like, yes, it's true. If they cut rates to zero, could it possibly stave off a recession? Like, yes, but why? Why would they ever do that? Like, it doesn't make any sense. The macroeconomic pressures are not aligned with cutting rates aggressively.
Wait, so your base case is no landing or soft landing?
My base case is probably closest to a higher for longer scenario, which is the economy, keeps on going stronger than people expect particularly in the rates market, and the Fed just doesn't do that much
But we
as a
won't.
result.
But we'll unlikely get negative growth, GDP growth.
When will we get negative
We
GDP
will.
growth?
Sorry, we will unlikely get negative GDP growth. Is my question.
Yeah, in the near
Okay.
term, I mean, it's very, very
Yeah.
hard when you're at a growth rate at this level
Hmm.
and you see asset prices the way that they've grown, and you see, labor markets continue to be pretty good and income growth to be pretty good. I'm not saying it's booming. I'm just saying like it's fine. Um, where's the catalyst? What's the catalyst? What's the catalyst to create an acute slowing of the economy? Of course, there could be some external shock we don't predict, but absent that, like that's my question is like, where is the shock? Where is the thing that's going to create the acute slowing? Much more likely we just kind of get this kind of very, very gradual decline, softening of the economy that we've seen over the course of the last 2 years. But that's nothing not close to an immediate recession.
Very good, Bob. I appreciate your time today. Where can we learn more about you and your work?
Yeah, if folks were at least intrigued by these hot takes on the macroeconomy and markets, check me out on Twitter at Bobby Unlimited, where I run a pretty active account, as well as on YouTube, where I have various clips of my appearances. And if you want to learn more about what we're doing to bring hedge fund returns to all investors, check us out at unlimitedfunds.com.
All right, we'll put the links down below in the description, so make sure to check that out. Bob, I'd love to have you back on to talk more about hedge funds. We ran out of time today, but that would be an interesting topic. So thank you for being here today. Thank you for educating us.
Yeah, thanks so much for having me. It was fun.
Thank you for watching. Don't forget to like and subscribe.